I
That's
can hear you.
that's why you should just go live. You should not
Yeah,
anyway. Just forget it. Okay.
fair
Hello,
enough.
hello, everybody. I'm Toi Holliday, a realtor in Los Angeles, California, and today I would like to welcome Cheyenne. We are going to talk about some mortgage updates during the global pandemic for COVID-19. So, Cheyenne, why don't you go ahead and introduce yourself again?
Hi, I'm Cheyenne. I work with Mountain West Financial. The home office is in Midtown Sacramento.
Awesome, awesome, awesome. So the last call that we had, it was really, really great. We got a really good feedback with regards to some of the information, regarding, what's happening to the mortgage industry right now. So a lot has actually changed since our first video call, and so can you just take a few minutes to give us all an update on what has happened over the past several weeks?
Yeah, so Fannie Mae, Freddie Mac, they've tightened their lending restrictions in regard to debt to income ratio. So where before they might have been more flexible between 45 and 50%, they've narrowed that to between 43 and 45%. Down payment assistance programs at one time was at 620 minimum FICO score. With CalHFA and GSFA, they've bumped those now to 660 both, regardless of the program. They're both at minimum of 660 to qualify.
Hmm.
So big changes.
Yeah, those are really big changes. So can you repeat again what type of debt to ratio that a new home buyer would be looking to?
Yeah, so the maximum that we're looking at on the conventional side would be 45%. It's going to be 43 is kind of the guideline, but between 43 and 45,
Hmm.
depending on what our desktop underwriter approves, that's known as DU through Fannie Mae.
Hmm.
I've seen up to 45%, but buyers before that had high FICO that were between 45 and 50, unfortunately, we're getting pushback on that.
Okay, a lot of pushback on that. Okay, now with regards to like down payment assistance programs,
Mhm.
can we talk about the guideline for person's income? Like, are there any limits?
Oh, well, so with the Golden State Finance Authority, there is no income limit. It's based upon FHA guideline, and FHA currently doesn't have an income limit. So yeah, so at this point, there is not an income limit with them. With the with the CalHFA, which is the California Housing Finance Agency, there is income limits, but it's
Hmm.
based by the county of.
Okay, okay, great. Now I know that that GSA has been around for quite a while. Can you give us a little more information about the background of GSA, the Golden State
Yeah,
program?
the Golden State Finance Authority is a nonprofit organization. Home office is in Sacramento. It is a nonprofit organization designed to help home buyers through either second mortgage assistance, meaning their primary mortgage is conventional or FHA, but the second mortgage it's a silent second that isn't required to be paid back until
Mhm.
they sell a house or refinance it. Another form, depending upon their employment, so state employees, teachers, first responders to include
Mhm.
police, paramedic, fire and rescue. These folks get grants. So they are required to live in their house for a minimum of a year. But as far as repayment is concerned, certain employment categories get their down payment assistance as a grant. I think of it as a gift, if you will, through the
Mhm.
Golden State Finance Authority.
Okay. Now, is that similar to what I've heard before, that there's a program called the neighborhood program, where it's police officers, EMTs, doctors, and different people who work in the area. Is that similar to that program, or is that actually
Absolutely.
the neighborhood program?
Yeah, so the difference between the neighborhood program and GSFA is Golden State Finance Authority. It's statewide. So no matter if you're San Diego County all the way up to Shasta County and every county in the middle, they would qualify regardless of the city that they're buying in. Or neighborhood programs is specific to the county or even the zip codes where those particular properties are located. So there is a difference between them, but effectively the programs themselves are designed very similarly.
Mhm. Okay, now let's talk about veterans. So how does all this that's going on right now with the global pandemic, how does that affect veterans who want to purchase a home?
So as long as we can validate or verify their certificate of eligibility through the Veteran Administration, and we have electronic portals to do that. So Veteran Administration has made changes to getting pre-approvals and verifying certificates of eligibility for veteran buyers, but we're getting them qualified the same as we would a traditional borrower.
Okay, awesome, awesome. Okay, so the next question that came up is with regards to current homeowners who are thinking about refinancing. So what are some of the roadblocks that they're coming into at this particular time?
Well, not roadblocks per se, but rates over the last, say, 10 to 15 days have been in favor of people who had traditionally bought maybe a year or 2 years or even 5 years ago when they want to refinance and take advantage of low rates. As long as we can validate their income, as long as we can validate their assets, those two things, we're not having much trouble with refinances right now.
Okay, awesome, awesome. Now, the other day, I threw a scenario out to you, a client that I have been working with, and um, with regards to someone who has recently or who they're thinking about, filing a bankruptcy and they own a home, what are some of the things that they can look for in terms of, trying to keep their home and then trying to refinance it?
Good question. So there, we could probably spend 10 minutes talking about foreclosure or short sale or deeds in lieu of. Let's avoid that. But you're saying, let's say somebody has already filed bankruptcy and
Mm-hmm.
they're coming through it and they want to be a homeowner now.
Yes.
One resource we can do with government lending to include USDA and FHA, the government guidelines are 24 months minimum removed, and during the most recent 12 months of the application have had no derogatory debt, meaning no missed payments, car loan, student loan, credit card debt, no missed payments there. And they must have reestablished credit since the bankruptcy. For example, 3 years ago, someone filed bankruptcy, but today they want to borrow money, they want to buy a home. So they must have reestablished credit since then, buying a car, getting a credit card, something of that nature, and have not had derogatory debt in the most recent 12 months. So if they applied today, we look at today and move back 12 months. If there's any missed payments, if they haven't reestablished credit, unfortunately, that's a pass for those borrowers. But 24 months removed for government lending. For conventional home loans, such as Fannie Mae, Freddie Mac, it's 4 years or 48 months.
Okay,
Same
wonderful,
guidelines
wonderful.
apply. So reestablish credit, no derogatory debt in the last 12 months.
Okay, wonderful, wonderful, great. Let's see. Let's see. Do you have any other like tips or nuggets that you can share with the people viewing?
Yeah, absolutely. So there's this common misnomer for people that, let's just say they applied with Wells Fargo. I'm using them as an example, or Chase or Bank of America, that they're the points that are going to affect them for having a hard credit pull, it's like 15 to 20 points. And the truth is, the maximum that it's going to affect is between maybe 5, 6, or 7 points. And because of the Fair Credit Reporting Act updates that happened a couple years back, you can have buyers apply for home loans with multiple lenders in a 30-day window of time, and it only affects them one time. For example, they apply with Wells Fargo, they apply with Chase, they apply with Gold One Credit Union, and then they apply with me. There'll be 4 inquiries on their credit bureau. However, they're only affected one time. So if they were at a 770, for example, FICO score, they could look to have a 765 or 763 FICO score after all 4 inquiries. So it only affects you one time, though there's multiple inquiries in a 30-day window of time.
That is so wonderful to know, because I hear that so often. They're like, oh, well, I've already had my credit ran. I don't want to have it ran again. It's going to bring my score down and things like that. And I want to thank you for, sharing that and clearing up that misconception.
Absolutely.
Yes. So, Cheyenne, I want to thank you so much for joining me today. And I
Thank
am
you.
actually going to leave your contact information as soon as I click end here so that people will know how to get in touch with you. And
Great.
Cheyenne, can you pronounce your last name for me?
It's DeWeese. It's Dutch.
DeWeese, just like
Yes.
it's spelled, right?
Well, I've heard all different kinds of ways to pronounce it, but yeah, that's how it's pronounced.
Wonderful. Awesome. Thank you so much. I do appreciate your time today, and I hope you have a fantastic afternoon.
You as well. Thank you, Toi.
Okay, take care now.